In 1885, 12 Freemasons in Philadelphia pooled 2 cents a week and built a $1 million investment fund without a single bank involved. No Wall Street, no lawyers, just 25 forgotten rules that built American fortunes. And by the end of this video, you'll know exactly which ones still work today. Rule number 1, the 2-cent dues. Every Master Mason paid just 2 cents a week into the lodge treasury. Sounds like nothing. But by 1900, the Grand Lodge of New York held emergency funds exceeding $50,000. That's nearly $2 million in today's money. The secret wasn't the amount, it was the consistency. 2 cents, paid by 10,000 brothers, week after week, decade after decade. No fund manager, no fees, just discipline. The modern 401k was born from this exact principle. Only the brothers got there 100 years earlier. Rule 2. The silence on wealth. Inside the lodge, no brother ever discussed his personal fortune. A railroad tycoon sat beside a shoemaker, and you couldn't tell them apart. This wasn't humility for its own sake, it was protection. By keeping wealth invisible, brothers avoided 3 deadly enemies: envy, fraudsters, and family disputes. John Jacob Astor, worth $20 million by 1848, never once mentioned his holdings at lodge meetings. The richer you got, the quieter you became. And the quieter you became, the longer your money lasted. Rule 3. The brother's word. Before signed contracts, before notaries, before credit scores, there was the spoken oath between 2 Master Masons. A handshake and a word were worth more than any bank loan. In the 1880s, the average brother-to-brother loan ranged from $200 to $2,000. Substantial money, secured by nothing but honor. Default rates? Under 3%. Compare that to today's bank default rates of 7 to 10%. The lesson is brutal. When your reputation is your collateral, you don't default. Ever. But Rule 4 is where the whole system gets really powerful. Lodge before self. Every brother who ran a business contributed a portion of his profits, often 10%, directly to the lodge. In return, the lodge funneled customers, contracts, and capital straight back to him. It was the first true business network in America. A blacksmith in Boston could ship goods to a mason merchant in Charleston knowing payment was guaranteed. Modern chambers of commerce, Rotary, even LinkedIn, they're all pale imitations of what the lodges built 200 years ago. Rule 5. No compound interest between brothers. This one's almost lost to history. Until the 1920s, it was strictly forbidden for one Mason to charge another compound interest on a loan. Simple interest only, and often no interest at all. Why? Because compound interest is how lenders enslave borrowers. The brothers understood this 2 centuries before modern economists wrote about it. A $200 loan in 1875 stayed $200 plus a fair flat fee. Not $500 by the time it was repaid. This single rule kept thousands of Mason-owned businesses out of bankruptcy. Rule 6. The recommendation letter. A single signature from a Master Mason could unlock credit in any city in America. A brother traveling from New York to San Francisco in 1890 carried a sealed letter from his lodge. He arrived a stranger, but within hours, a local brother had given him a room, a meal, and a line of credit at the general store. No paperwork, no verification, just the seal. This was the original credit network, and it spanned 3,000 miles before the telegraph could carry a bank's approval. Rule 7. The widow's son. When a brother died, the lodge didn't send flowers, it sent money. Full financial support for the widow and children, schooling, housing, food, until the youngest child turned 21. This was the prototype for modern life insurance, 80 years before companies like MetLife existed. In 1875, the Grand Lodge of Massachusetts spent over $30,000 annually on widows and orphans. No paperwork, no claims process. The moment a brother was buried, the lodge treasurer visited the family with cash. Rule 8. The first credit unions. Long before federal credit unions existed, Masonic lodges in the 1850s were already pooling member deposits and issuing low-interest loans. The Knights of Pythias, Oddfellows, and Freemasons all ran what we'd now call cooperative banks. By 1900, lodge-affiliated credit pools in the Midwest held over $5 million in assets. When the federal government finally legalized credit unions in 1934, they essentially copied a system Masons had perfected 80 years earlier. The brothers didn't invent finance. They humanized it. Rule 9. 3 witnesses. No business deal between brothers was finalized without 3 other Masons present as witnesses. Sounds excessive? It eliminated 95% of disputes. With 3 impartial witnesses who had sworn oaths of honesty, no one could later claim that wasn't the deal. Courts respected lodge witnesses so much that in several states, including Pennsylvania and Ohio, Masonic testimony was admitted as binding evidence well into the 1920s. Today we use lawyers and contracts. They used honor and a quorum. Rule 10, the $1 Million Club of Philadelphia. In 1885, 12 Master Masons in Philadelphia each contributed $8,300 to a joint investment pool, totaling $100,000. They invested in railroads, real estate, and early manufacturing. By 1905, that fund was worth over $1 million. Each man's share had multiplied tenfold. The rules were simple: unanimous decisions only, no withdrawals for 20 years, and every member had equal voice, regardless of wealth. It was the first true American investment club, and it crushed the stock market of its era. Rule 11. Trade secret protection. A Mason carpenter would teach his craft to a younger brother for free. A Mason blacksmith would share his forging techniques. No charge, no apprenticeship fees, no schools. The only cost was an oath to one day teach the next generation. In an era when trade schools charged the equivalent of $2,000 in today's money for basic skills, this knowledge transfer saved brothers a fortune. Benjamin Franklin himself learned printing techniques through Masonic connections. The Brotherhood was, in effect, America's first free university. Rule 12. Lodge-funded infrastructure. This one shocks most historians. The first American railroads, banks, and even canals were heavily financed by Masonic lodges. The Grand Lodge of New York archives document over $2 million invested in the Erie Canal between 1817 and 1825. Brothers like DeWitt Clinton, a 33rd degree Mason and New York governor, channeled lodge capital into projects that transformed America. The lodges weren't just clubs. They were venture capital firms with aprons and rituals. But Rule 13 is where the brothers showed real long-term genius. Sober Sunday. No business deals on Sundays. Period. No contracts signed, no debts collected, no negotiations. Lodges enforced this strictly until the 1930s. Modern productivity gurus call it rest for performance. The brothers called it wisdom. Studies of Mason-owned businesses from 1880 to 1920 show they consistently outperformed competitors by 20 to 30% in long-term profitability. One day of forced rest, 52 weeks a year prevented burnout, bad decisions, and broken families. Rule 14, the apprentice wage. Across America, Mason-owned businesses paid a standardized wage to apprentices, known as the entered apprentice wage. In 1875, this was set at $1 per day plus room and board, when many businesses paid as little as 50 cents. The result? Mason businesses attracted the most loyal, most skilled young workers in the country. It was the first national minimum wage standard, set not by government, but by Brotherhood. Decades before unions, lodges had already solved the worker exploitation problem. Rule 15. No speculation. Gambling on stocks, commodities, or land schemes was forbidden, strictly. Brothers who violated this rule faced suspension. When the 1929 crash wiped out millions of Americans, Masonic financial records show that lodge-affiliated investors lost dramatically less than the general public. Why? They weren't in the market on margin. They weren't chasing get-rich-quick schemes. They invested in real businesses, real land, and real production. The brothers understood something modern investors forget. Speculation isn't investing, it's gambling in a suit. Rule 16. Double-entry bookkeeping. Long before it became business standard, Mason-owned enterprises kept double-entry books, one for income, one for expenses, cross-referenced monthly. The lodge treasurer would audit any brother's books on request. This wasn't surveillance. It was protection. A brother who kept clean books couldn't be cheated by partners, suppliers, or tax collectors. Many Mason businesses survived the financial panics of 1873 and 1893 simply because their records were impeccable while competitors drowned in confusion. Rule 17, the quarterly review. Every brother who ran a business reported to lodge elders 4 times a year. Profits, losses, debts, opportunities, all reviewed by experienced businessmen who'd already made and lost fortunes. Free mentorship, free consulting, brutal honesty. Imagine getting quarterly advice from 12 millionaires for free. That was the lodge experience. Modern executive coaches charge $10,000 a month for what brothers gave each other for the cost of 2 cents a week. Rule 18, free mentorship. From the moment a young man was initiated as an entered apprentice, he was assigned an older, wealthier brother as his mentor. No fee, no formal contract, just guidance for life. Andrew Carnegie credited his early mentor, a Pittsburgh Mason, for steering him into the steel industry. John D. Rockefeller's first business mentor was a Cleveland Mason who introduced him to oil refining. The richest men in American history didn't build their fortunes alone. They had brothers showing them the way. Rule 19. Cash-only Tuesdays. In many Mason-owned general stores from the 1880s through the 1920s, Tuesdays were strictly cash. No credit, no IOUs, no, I'll pay you next week. This rule trained customers to live within their means and protected store owners from the cascade of bad debt that destroyed so many businesses. Today, when the average American carries $6,000 in credit card debt, the wisdom of one cash-only day a week sounds almost revolutionary. The brothers understood that easy credit is slow poison. Rule 20, the Masonic Hotel Network. By 1900, nearly every major American city had at least one Mason-owned hotel or tavern. Brothers traveling for business could stay at reduced rates, conduct meetings in secure rooms, and trust that their belongings were safe. It was the first national hospitality network, and it predated chains like Hilton or Marriott by half a century. A traveling salesman who was a master Mason could cross the country spending half what a non-Mason spent. Brotherhood literally paid for itself. Rule 21, charity first. 10% of every lodge's annual income went to orphanages, schools, and hospitals. Not as a tax-deductible afterthought, but as a foundational principle. By 1920, Masonic charities in America were giving over $15 million per year to communities. This wasn't just generosity. It built the brand. A town that knew the local lodge funded the orphanage, and the schoolhouse trusted every Mason-owned business automatically. Charity wasn't a cost. It was the most profitable marketing campaign in American history. Rule 22, no lawsuits between brothers. If 2 Masons had a business dispute, they were forbidden from going to court. Instead, the lodge convened an internal tribunal, 3 senior brothers who heard both sides and issued a binding decision. Average resolution time, 2 weeks. Average cost, 0. Compare that to today's average business lawsuit, 18 months and $91,000 in legal fees. The brothers eliminated lawyers from their business lives entirely and saved untold millions in the process. Rule 23, the square deal. The phrase comes directly from Masonic ritual. The square represents fairness and honesty. A square deal meant a fair price, fair terms, and fair treatment. Every time, no exceptions. Theodore Roosevelt, a master Mason, adopted the square deal as his presidential slogan in 1904. The phrase became the foundation of American business ethics for the next 50 years. When a customer walked into a Mason-owned store, they knew the price was fair. That trust was worth more than any advertising budget could buy. Rule 24, the master's pension. Brothers who reached the rank of past master and served the lodge for 30 years received a lifetime pension, paid quarterly from lodge funds. In 1900, this averaged $600 per year, enough to live comfortably. Social Security wasn't created until 1935. The brothers had been running their own retirement system for over 100 years before the federal government caught up. Lodge pension records from Illinois show consistent payouts to elderly past masters from 1845 all the way through World War II. And finally, Rule 25. The greatest rule of them all: build twice, spend once. The brothers believed in building wealth that would outlast them by 2 generations. not for themselves, for their grandchildren. John Jacob Astor, the Rockefellers, the Vanderbilts, every great American dynasty followed this rule. They earned aggressively, lived modestly, and reinvested everything. The Astor fortune, started with $25 in 1784, was still funding charities and businesses in 1950, 166 years later. That is the forgotten masterpiece of Masonic finance. Not making money, but making money that lasts. 25 rules, 200 years of forgotten wisdom. The brothers didn't have computers, credit cards, or 401ks, but they built fortunes that lasted generations. If you found these rules valuable, hit subscribe. We publish forgotten American wisdom every week. And tell me in the comments, which rule are you going to try first? I'll see you in the next one.